how would you compare the default risk, say between, Broadmark and Annaly? Broadmark invests in, like, if you go to their website, it's really kind of interesting. They you can look at, like, they did $1.5 million for a spec house in Utah, $2.8 million, something like that, for a bunch of townhomes, like 4 or 5 in Seattle. These are retail things.
Sure.
Then you look at, and they have they said they won't loan over 65% loan to value. So that's, that limits the risk there. But then you look at Broadmark, or you look at Annaly, which is 10 times the size in assets or something like that. And they're primarily buying Fannie Mae, Freddie Mac, government guaranteed loans. Doesn't that lower the default risk?
So remember that I mentioned 2 big risk factors. One is that interest rate risk, the leverage risk, if you will. And then number 2 was the default risk. So default risk is why you saw them plunge during the early stages of the COVID pandemic. The leverage risk is why you saw Annaly go down during the rate hike cycle in 2017 to 2019. So Annaly doesn't have a lot of default risk. As you mentioned, its mortgages are generally government guaranteed. I'll go ahead and put up the Annaly slide because I have that queued up. But Annaly's portfolio is 92%. 92% of its portfolio is made up of agency-backed mortgages, Fannie Mae, Freddie Mac, conforming mortgages, government guaranteed. Commercial loans and mortgage servicing rights make up the rest of their portfolio. So they don't have default risk in that sense. But, and here's this last bullet tells you where the risk comes from. Annaly uses a leverage ratio of 5.8 to 1 to achieve its returns. That means for every dollar of invested capital, they're borrowing $5.80 to help buy mortgages. That's a pretty high leverage ratio. That's where their risk comes from. Because if their interest rate they have to pay on that borrowed money goes up, and these mortgages they own are fixed rate, so they keep paying the same no matter what. So their mortgages keep paying 3%. If their cost of borrowing rises to 2 or 3%, you can see where their profit margin would evaporate very quickly. That's why they got hit so hard during that last rate hike cycle, and they had to cut their dividend and things like that. So to answer your question, they don't have a lot of default risk, but they do have a lot of that leverage risk. Now, Broadmark is the other story that you just mentioned. And here's ticker symbol BRMK. Someone asked that earlier. So you kind of already mentioned what they do a little bit. Broadmark specializes in hard money loans. Think of these as short-term loans for construction projects. I think what you mentioned, a mall. You can give us a better overview.
Even smaller than that. I mean, there was a $1.5 million spec home in Utah that a builder was building. Another one was a few townhomes in Seattle for a few $1 million. I mean, none of the ones that they were featuring on their homepage or on their webpage of projects were over a few $1 million. These were all like, single builder, or maybe a little local consortium of builders type loans.
So these are loans that are short-term in nature. They're, I think,
yes.
I think typical
loans. Yes.
Yeah. Mm-hmm. I think the typical hard money loan is anywhere from like 6 to 24 months in duration. And as any real estate investor who's used one can tell you, hard money loans generally have higher interest rates. It's not uncommon, even in the current low interest rate environment, to find 8, 9, 10% rates on hard money loans because they're designed for short-term needs in situations like where you can add value to a property through a rehab project where it might be worth paying that kind of money. But here's the point, and this is kind of what Mark was alluding to as well. Unlike most mortgage REITs, Broadmark uses no leverage at all. They do not borrow any money. If they have $1 billion in the bank, they will make $1 billion in loans. So it doesn't have that leverage risk when rates start going up. So it can do this because those short-term hard money loans have high interest rates. But it has higher default risk. These are not government guaranteed loans. And one of the reasons that hard money loans charge higher interest rates is because they're inherently riskier. Construction projects go over budget all the time. I can bring on contractor friends that can tell you that. Rehab projects don't work out for one reason or another. A lot of times short-term loans are based on the borrower's ability to sell the property before the end of the term, which isn't a guarantee. So these have higher default risk, but they don't have that leverage risk, which is why, if you saw in that chart, Broadmark held up the best of those 4 REITs during the early days of COVID. And it's precisely for that reason, because they didn't have to worry about things like margin calls. As long as their borrowers kept paying their loans, they weren't really worried about it. Now, the market was, obviously, when you saw that price correction, but that is Broadmark. So those are the first 2 I wanted to talk about. Then I had one more that I would put in my top 3. Quality really matters when you're talking about a mortgage REIT, by the way. There are a bunch of them. Most of them are not worth a look. So we're trying to kind of weed out, if you are going to use these to create some yield, we're trying to, at least steer you in the right direction. So the 2 that we've talked about so far are very different risk dynamics. And they're the 2 extremes, which is neat that you have them both in your portfolio, because they're kind of, one is like extreme default risk, but no leverage risk. One is extreme leverage risk, but no default risk. So it's a nice complement to each other, I guess you'd say. If there was such thing as a diverse portfolio of mortgage REITs, I think you're on the right track.